Oh my, oh my, oh my. It's Friday once again. Happy Friday, Sarah. How you doing?
Good. How are you, Zach?
Doing very well, thank you. Doing very well, thank you. It's Financially Fluent Friday. Sarah Haliburton with the Beer Home Team, ready to.
Nice to see you all.
We're going to drop some knowledge on you guys today. How you doing today? So you looks like you've been out. You said you've been out walking properties today, huh?
Yep. Today I got some ugly ones, so we're out looking at them, seeing if there's any opportunity there, and make them pretty again.
Investors specials, huh?
Yep. All cash only, unfortunately.
So I've seen a couple of those recently. I think those are always interesting when you take a look at them. So cool. Well, yeah, let's. I know you got a lot going on too, so let's just jump right into it. I know one of the things I want to talk about that I think you and I both have seen a lot of people ask about recently are the Mello-Roos taxes or the CFDs that are basically just improvement funds. And this is really relevant now. It's always been an important conversation, but I think it's more relevant now than ever because we're seeing obviously the market shift as it has. We've seen prices and rates move and all of that. So we need to talk about what they are, how they can impact you, and what to do. So, from your perspective, obviously, I know I could talk a lot about what they are, what they mean for the loan side of things, but tell me a little bit about a Mello-Roos and a CFD, Sarah.
So the way that we explain it, or I explain it to my clients, is imagine an area that's underdeveloped, right? There's nothing there. There's no schools, no streets, no stoplights, no parks, no nothing. They decide to put in a development. Someone's got to pay for the infrastructure of that development, meaning the schools, the streets, the stoplights, etc. So an investor comes in, offers to pay for it, and you, as the homeowner, will pay that back over time. And that is essentially what the Mello-Roos tax is. It's you paying back for the infrastructure of the city in which they built that section. This is really common in areas like Forest Ranch, Otay, anywhere that was not already developed as a city per se, because they didn't have that infrastructure. So that's the easy way I explain it. Now I'm sure that you have other insight as well. So let me know what you say.
No, you really nailed it. Actually, I think that's the best. That's a really clean explanation. But the thing to think about, obviously, right away, there's pros and cons to them. The biggest thing that the real advantage is that you're getting all new. So you're getting new schools, you're getting new infrastructure, which is, obviously anybody who lives in the unincorporated areas will tell you that the infrastructure wears over time. If you're living in an established city already, you'll see that the infrastructure and the schools are sometimes good, sometimes bad, depends on the situation. So, that's exactly that. You're going to get the newest schools. You're going to get the newest, nicest parks. You're going to get the newest, the freshest infrastructure as far as water and all that sort of thing as well. But the downside or things you have to be aware of is that it's an added cost. And a lot of times, if we don't think about it or plan ahead, people will look at properties. I know that I'm sure you have people that'll, even though we send them searches and we send them all our lists, people still do the Zillow hunt or the Redfin hunt. And a lot of times, if they don't know what they're looking for, they're not going to see those items. So if they're shopping kind of towards the top high end, or they're very payment sensitive, which, as a lot of people, obviously, then they're going to get into a situation where that can negatively impact their buying power. So some people will fall in love with a property and not realize that, they don't necessarily want to make that payment or don't qualify. A good example is I had a client that was looking at some new condos. And, I told them, give me the information, give me the property. And they didn't have addresses and they didn't have the development. They just kind of said, we're looking at these condos over here. Okay, well, here's what you qualify for. This is kind of the high end of where you qualify, but I don't know anything about that property. So long story short, they went and they did the cross qualification and they didn't qualify. When I took a look at everything, it was because there was additional Mello-Roos and taxes and fees that they hadn't looked at. Now we're going to look at ways to get them approved and work around that, because there's some ninja work that I can do. But sorry, you're going to hear some construction in the background. I don't know if you can hear it, but we're doing some remodel work here. But so that's the downside you have to be aware of. So you nailed it as far as the explanation of them. It's just something you really have to watch out for.
And Zach, correct me if I'm wrong, but a lot of times and you also see this a lot in Riverside County also, is the Mello-Roos tax. But I think it also impacts the property tax rate. And you'll start to see a higher property tax rate on top of the Mello-Roos, on top of typically an HOA. So when you're looking at your payment, you have 3 additional factors versus something that's maybe an older home in an established area.
Sometimes they'll even build the Mello-Roos actually partially into the property tax bill. You'll see it itemized on the bill as well. And so you'll see that. Sometimes they'll have separate fees, but generally speaking, I actually see them tend to get combined in there as well. So the nice thing is you do get a tax deduction on some of that because it's written into the taxes on a lot of situations. And this also, this can also happen for some areas where maybe they've and that aren't necessarily new, but they've voted to add on extra bonds to pay for things. So you start to see those tax rates go up because they're doing improvements. And again, pros that you're getting new things, you're getting schools improved, you're getting other things around you improved. But at the end of the day, it does add to the cost. Nice thing though is that they're not forever. So they will eventually go away, but it's not an immediate thing. I think it's, generally speaking, it's 20 years is something you're looking at for something like that. So it's not a short term. It's going to
also
go.
vote to extend it, just so you know. So
Oh yeah,
beware. They can be
yeah. We know
extended.
how. Yeah, we know how they love voting to extend everything. I think anyhow. Good. Let's stay off that topic anyhow. All right. Well, I think we covered that. The biggest thing, guys, make sure you're looking. Make sure if you're looking at a newer development, get the property information, get it to your lender, talk to your realtor as well. They'll be able to tell you if there's CFDs and to look for those things. And it's really important. It can impact you and it can impact your buying power. So let's just make sure you look at that. So, let's take a look. Another topic that you brought up, I think, is a really good one that's very relevant again right now is how do you move before you sell or close the sale of your home? And I want you to start off again because this is something that I know you've experienced quite a bit right now. Let's talk about it.
I think a lot of people get nervous when they want to move somewhere, whether it be out of state or in the same city, but they want to move, but they have a house to sell and they're not quite sure how to do that, right? They hear, oh, contingent offers don't get accepted. They hear all of these different things. So what are their options and how can they move successfully and sell this property? Number one, I always recommend selling before you buy so that you know exactly how much you're working with, right? So if I think my budget based on my house selling at 800 is a million, whatever the case may be, but in reality, my house sells for 900. Could I have bought something at 1.1? And maybe that's what I really wanted. So I always recommend to my sellers that have to purchase, you should list first, number one, so that you're not contingent, and number two, so that you actually know how much money you're working with. Because the opposite could happen too in some markets. Maybe it doesn't sell for 800, maybe it sells for 700. But now I'm committed to a house at $1 million when I really wanted to be at 900. So I always recommend sell before you buy, and those are some of the reasons. Now, how do I do that? Well, you have a couple options. You could sell first and do a rent back. I heard a rumor that rent backs weren't a thing, and I want to debunk that. They are absolutely a thing. I have 2 clients right now that are in rent backs until the end of June, but they're going to close at the end of April. So it is absolutely a thing. It's absolutely negotiable, and you can do it up to 59 days. Correct, Zach? 59 days.
Correct. We'll dive in on that in a little bit here as well. We'll get a little more into the weeds on that too.
You could do something called a bridge loan, which Zach, I'm sure you can explain much better than I. And the other thing is there are companies now that are actually doing cash purchases. So they'll actually buy your house for cash, allow you to go purchase the home of your dreams, and then sell your home and actually pay you the difference if it sells for more than what they originally offered you. Now, there is a cost on the money, and we won't get too into the weeds there, but just know that there are options. So, yep. Zach, if maybe you could explain very briefly what a bridge loan is, and then we'll go into rent backs.
Yeah, so a bridge loan is basically temporary financing. It's a loan that you're going to get that's going to help you get the funds that you need to get the down payment, get yourself into the property, and essentially it's going to be something that you're going to pay off very quickly once the sale of your property closes. They're little, the terms are, they're not always going to be the greatest terms, but the whole idea is that it's a temporary loan and it's going to get you where you need to go. It's going to bridge that gap from where you are to where you need to be. And so that's definitely an option to consider. Another thing too is this: if you were, there's 2 sides of the coin. Do you need all the money that you're walking away from for a down payment? If you do, obviously the option we've just discussed. If you're in a position where you have some assets set aside as well, you could also consider utilizing those assets. If it's an issue where your income and debt ratios are wrong, you can also rent out on paper, at least the property for a while and get that rental agreement going as far as to get through the loan process. Now, obviously, I'm never going to recommend doing anything that's against the rules. I'm never going to recommend ever, breaking rules and things like that. But it is an option that will give you a little bit more runway to potentially get where you need to go as well. So you don't necessarily have to sell right away. There's obviously, we can get into talk about renters and all that stuff later down the line, but there are some options there too. So the biggest thing is this: there's options. You can definitely work around those. And actually, one option that I think you talked about just a second ago that I want to dig in on, because I think this one is big right now, is let's talk a little bit more about rent backs. Because I think that realistically right now, the best option that I'm hearing, and it's consistent across the board, and it's very common right now, is to help in terms of how to sell before you move, is a rent back. So let's talk about that a little bit more depth, Sarah. Give me your 10 cents. I know you've negotiated that quite a bit. You mentioned a couple. So
the essential things to note about a rent back is that the buyer is going to go through the buyer process, right? So they're going to do their inspection, they're going to do their appraisal, they're going to get their loan, and then they're going to close. Once the closing occurs, now the seller becomes a tenant. So there's a couple different ways to structure the rent back. Right now, in a competitive market where there's no inventory, I'm seeing buyers offer free rent backs for anywhere from 7 days to 59 days. And so they're doing it for free. They're giving the seller the option to live there for free for the next 2 months. And all that they're requiring is a minimal deposit, like a $3,500 deposit that will go back to the seller upon move out. And that's just to kind of, create some sort of security that the seller is actually going to move. Now, the seller can leave earlier if they want. Most of my clients that are in rent backs right now, they're moving out of area, or they're moving into the area, but, temporarily they have to move to Chula Vista, but their kids go to school in Forest Ranch. That commute's going to kill them. So the buyer offered, hey, if we can win this deal and we can win the offer, we'll let you live there for free until school's out. So that's kind of the situation. Now, you could also charge for rent. Sometimes I see buyers ask for the PITI to be covered, the principal, interest, taxes, and insurance. Sometimes they'll require that the HOA be covered, or that the maintenance, if there's a pool or a gardener that's all upkept. But essentially, the seller now becomes the tenant.
Because here's the thing, right away, and you nailed it. I love the way you explain that, and obviously you can tell you've done it quite a bit. Here's the thing. First off, the seller is going to pay the interest for the month they close, and then they're not going to have another mortgage payment for at least a month after that. So they're going to be in a position where, they're not going to be as hurt. Now, they are going to be responsible for the mortgage payment eventually. They do need to make their payment, and that definitely is important. But, I think I lost her. I think Sarah will come back on in a second. So I'll just kind of talk about this a little bit and then get her back on with us. So when they close, the seller's going to pay the interest for that month. So let's say we're in April. They close April 15th. They're going to pay the 15 days of interest through to the end of the month. Then let's bring Sarah back on here. Well, if you didn't want to talk to me, you didn't have to hang up on me. Shoot.
Sorry, got a call and it just went bloop.
No worries. So I was explaining that, realistically, the seller is going to pay the interest. So let's say we close April 15th. They're going to pay the interest through to the end of the month here. So 15 days of interest. And then they're not going to have another mortgage payment until June 1st, right? So they're going to skip the May payment because the June 1st payment pays for May. So they're not going to be double paying. So that's why there's some impetus there for that. That's why it works, at least for the sellers in a lot of situations. And the other thing is this. Right now, as you've heard, and we've talked about, we beat like the dead horse a couple times. Rates are moving, and so there's a lot of benefit for that client to go ahead and get the transaction closed. They don't have to worry about extending their rate. They don't have to worry about the rates changing on them. They don't have to also worry about, for example, the fallout. They're going to have you close, and when the loan's closed, when the purchase is closed, it's a done deal. They own the home now. I've had people ask, and I've had a couple clients that were a little worried about what happens if that seller doesn't want to leave. And I've heard of one situation where it got a little hairy, but I've had a lot of clients do the very, very similar. And it's nerve-wracking because it's a big financial investment. It's your home. You have to plan about when you're going to move and all of those things. But the reality is this: I've yet to see someone say, "No, heck with it, I'm not leaving." I've not had it, and obviously we know in California there are squatters issues and all those sorts of things, but I have not seen that in this situation because, like you said, generally speaking, all it is that seller needs an opportunity to basically find the replacement home and get themselves in the right position, whether they're moving out of state, which is a big move. Sometimes they've never been there before. And then, or they're, like you said, they need to find the area that's going to work. They want to end up the school year, that sort of thing. So I don't think that's as big a concern. Have you run into that's a valid question. Have you run into situations where the seller said, "No, I'm out. I'm not leaving."
So I've been in this business 8 years, done over 100 transactions, plenty of rent backs, and I personally have never had an issue. Now, a member on my team has had one seller that decided not to move. But I mean, out of all of the transactions that we've done, like last year we did 770, and plenty of rent backs, no issues. So I've heard of one out of all of them. So, I mean, I guess you always get that one person. It is a risk. That's why I usually advise my buyers that are getting into this situation, get a hefty deposit up front. That way, if you need to seek out any sort of protection, you can. But that's really, I think it's very, very far and few between. And I think that you're very protected in the contract.
Yeah, absolutely. I mean, I've had another colleague that came to the point where it got right down to the wire, and they, when the buyer went in to start. Sorry, again, they're tacking in some baseboard right now. You might hear the nail gun. The seller was still there when they went in and started painting rooms. They were kind of slowly working their way out. And so they had stuff in one room, and the buyer went into another room, started painting, but they got out in time. And it was one of those things where they were contacting everybody. I heard the listing agent actually came and helped them get the heck out. There's a lot of impetus for partners to want to get in, because also from the other side of things professionally, our reputation's right on these things, especially on the realtor side. And so they want to make sure that they're doing everything in their power to get that transaction fully closed, all the way done. Because that way the buyer's agents are going to be more likely to work with them in the future. Because as you and I well know, this is a very reputation-based business. And if we have a situation where we have an agent that's not known to be responsive for whatever reason, they tend to not be as successful in the long run, I guess is the nice way to put it. So in terms of being able to working with other 100%. Agents. Yeah. All right. Well,
Zach, I think that's a great topic for next week.
I will definitely touch on that next week. All right, guys. Well, hey, happy Friday, happy Good Friday, happy Passover, happy Easter to everybody out there. And I hope you enjoy this weekend. Sarah, you have any plans with the family?
Just, your traditional Easter basket, egg hunt, Easter bunny stuff. So I hope you all have a great Easter, and we'll catch you next week.
All right, have a great day. See you.